I want to get right to it today. No holds barred. The main reason why many of us don't get our blessings is because we don't give enough. Let's start being better givers than receivers. Let's see how that works out. I know how it works. Once you get the giving down, you start receiving. The giving is for you, not for them. With that being said, we need you to hit that subscribe for us and the like button. We put in a lot of work for this content and it's extremely valuable. This content will change your life. So help us out. Hit that subscribe so we can take our valuable time and give you this $1 billion content. Thank you. Strap up. It's game time. Let's get it. Okay, here's the game plan. For this first clip, I really want to get you an idea of market conditions from some other experts so you hear it from them just as well as me. Oh, and guess what? Watch the whole video. All subscribers that make a comment in the comments section get a chance at free stock. We're going to do a live drawing with all my subscribers. And that's when we're going to do the giveaway. Pick your favorite stock symbol, whatever company you want, type it in the comments section and put the coinciding number beside it. So if you're the first subscriber to put one there, put 1 beside your name. If you're the third, put a 3. If you're the 15th, put a 15. If you're the 100th, put 100. Let's go. Let's get it.
Warren Buffett says a real estate storm is coming. Over $2.6 trillion of debt looming over the U.S. real estate market. And by the way, Warren Buffett is dumping stock as we speak. He's dumped most of his Bank of America stock. Should tell you that he knows something that you need to know. So what does Warren Buffett know about the marketplace, the stock market and the real estate market that you need to know? Look, guys, there is a real estate cataclysmic correction happening today. There's $2.7 trillion, and I'm going to share with you how you can take advantage of it and what you need to do about it. But when guys like Warren Buffett and Charlie Munger and Bill Ackman and people are starting to watch this marketplace and say something is going on in the marketplace that's problematic. For instance, we have more unrealized losses in banks today than we did in 2008, 9, and 10, which was a global economic crisis caused again by real estate, which was really a banking crisis, not a real estate crisis. Same thing's happening right now in 2024, 2025, and moving forward. $2.7 trillion. Just understand how big this number is. Will expire between now and the dates I just gave you. Today and the dates I just gave you, $2.7 trillion worth of debt is maturing due right now. It needs to be paid off somewhere between now and the next somewhere 20 months from now.
On the 9th of December 2024, we posted a video warning that the stock market was due for a short-term pullback. Since then, we've seen the S&P 500 correct by a few percentage points, and the RSP, an equal-weighted version of the S&P 500, correct by about 7%. The question now is whether we can already start being more optimistic on the performance of US stocks, or is there more pain to come before US stock market indices finally bottom out? There's two reasons for why the stock market has been declining recently. The first one is simply portfolio rebalancing. Back in early December, US fund managers had a 99% exposure rate to the US stock market. Of course, that left the market vulnerable to a decline in the event that these fund managers decided to reduce their exposure. Now, while these high levels of exposure don't guarantee corrections by any means, they certainly do increase the odds that one will happen. When we look
Okay, I showed you what some experts are saying. I showed you some technical analysis. All right, here's a little more. Don't go nowhere.
Since the last crash in 2009, share prices have risen 300%. Most Americans may be living paycheck to paycheck, but Wall Street is booming. By any metric, US share prices are now overvalued. Share price to earning ratios have reached record levels, higher than just before the dot-com bubble of 2001. The US stock market is now over 200% of GDP, 4 times that of the early 1990s. In early 2000, shares in tech firms soared, to crazy income multiples. They said this time is different because the new technology was the internet. But when the bubble burst, the Nasdaq fell 77%. This time it is artificial intelligence, which is a new source of enthusiasm. But never underestimate the limited intelligence of humans to get caught up in speculative bubbles. It's not just investors. Central bankers in the early 2000s felt they had tamed the economic cycle. Inflation was low, growth was high, everything was good with the world. But behind this seeming stability, financial whiz-kids had developed new ways of hiding bad debts and selling it on. It didn't end well. In 2008, financial markets and house prices crashed, and the crash would have been even worse if it hadn't been for massive government bailout and the central banks creating money out of nothing. 16 years on from the last crash, it now seems like a distant memory, and the Trump administration and even the new Labour government are wanting to loosen those post-crash regulations in a desperate effort to boost economic growth further.
Okay, so gave you a little bit of info about the bubble, gave you some info about the Trump effect. Stay dialed in. Here we go.
Barry Bannister from Stifel.
17th to chart.
Finally, we have a bear. Someone says stocks are going to fall, right? And I think when you dig into what Barry's saying here, of course, if someone's telling you that stocks are going to fall in 2025, they're probably going to talk about valuations, right? They're going to talk about how that puts maybe this market rally on a little bit of thinner ice. But what I think is interesting is what Bannister's getting at is something that is becoming a little bit part of the discussion right now as far as sticky inflation probably leads to less Fed rate cuts. And then the real kicker is a weaker economy. So one of the things we've talked about with all of these bulls and the large thing that people feel like is going to go well is a better than expected U.S. economy. That's been the trend since post-pandemic, is the U.S. economy has grown better than consensus. Well, Bannister thinks the U.S. economy probably grows at about a 1.5% annualized rate in the second half.
How does he get there, Josh?
It seems like overall, it's the impact of higher rates too, Josh. Remember, we're going to come back to that conversation, I think, in 2025, that eventually holding rates higher for longer does something to the economy. It hasn't to this point. That recession that we talked about for 2 years has not come, but there is still a take out there that at some point that's going to happen. He's talking about the consumer here. Consumer spending would slow down. Then your economy slows down. And this reminded me, guys, of a chart that we highlighted a week ago in our Morning Brief newsletter that Lori Calvasina shared from RBC on how markets do in different GDP regimes. So if you look at GDP over time, here you go, 1.1 to 2%. So that's Bannister's range, right? That's when the S&P 500 has not had positive returns. Where most strategists sort of sit right now would be right below that, predicting GDP in 2.1 to 3%, and you get about an 11% market rally. So again, kind of the key thing here being, if we're expecting the economy to do well, and markets are in large part about expectations, if the economy underperforms, maybe there's a concern not only is the economy slowing, but slowing to a point that we're starting to talk about recession again, and you're starting to price in more risks. Right now, it feels like this market is not pricing in a lot of risks, is something that not just Bannister's saying, a lot of strategists are saying that. The market is not pricing in a bad year for the U.S. economy, so if it comes in a little bit worse, that's when you start to talk about pullbacks.
Barry's been bearish, has he not?
He has been, he's been bearish, right. And so I think really, which is why I'm sort of saying the takeaway here is perhaps he's just staying with the risks here that everyone else is a little bit ignoring. But I have heard from a couple strategists in the past week that's been interesting thinking about the different scenarios that a higher inflation regime could lead to in 2025, right? The team over at UBS Asset Management was saying, well, if we have higher inflation and everyone's pricing in these Trump tariffs and these other things that could be inflationary, what if the president-elect decides, I don't want to bring up inflation higher, and he doesn't do any of the tariffs, and all of these things we've been pricing in the market and all of these outcomes don't actually happen? Then maybe your US exceptionalism thing, as you guys were just talking about, the US economy is supposed to do better than other economies, partially because of tariffs, right? If we slap tariffs on all of these other economies, it's in the model, Julie. I see your head moving. It's in the model. It's part of the model, at least. So if you take the tariffs out, then maybe there's opportunity elsewhere outside the U.S. equity market. It doesn't necessarily mean the U.S. equity market doesn't go up.
Just on a relative basis.
But on a relative basis, we're constantly talking about where you can make more money. And maybe there's a chance to make more money elsewhere if tariffs don't come, was one other interesting sort of thread here that's been floated around.
Yeah. Well,
We finally have a bear, guys. I don't know. I'm excited.
I like it.
You know?
It's now fun when everybody agrees.
Okay, I gave you info on valuation. I gave you info on rate cuts. Gave you info on slowing economy. I gave you info on, and I gave you info on not factoring in risk. Here we go. For those that would like to contribute, you can hit the pause button if you like. Here's our Cash App, and we appreciate everything you do. This is what we've been waiting on right here. This the money part. Get ready. This is the setup for success right here. Bases loaded, grand slam. I'm talking about walk-in touchdown, slam dunk, however you want to look at it. Setup for success. Let's get it. Write this down. Inverse ETF. Inverse ETFs, baby. This is where we score big.
Inverse ETFs are basically a way to win in a recession. If you guys are anything like me, you're probably trying to avoid checking your investments every day because you just don't want to see that negativity in your life. It's not fun opening up your trading app and seeing -5%, -10%, whatever it may be. It's definitely been a bloody start to the year. And honestly, pretty much everybody is in the same boat. People are losing left and right because all major indexes are down. The S&P 500 year to date is down almost 20%, and the NASDAQ is down almost 30%. So really, no matter where you go, you're probably losing money. So with losses piling up in all of these major indices, where can you put your money? A recession is potentially right around the corner. Maybe we'll get some news for the second quarter of this year and potentially could be in a recession, if not probably headed towards one later this year or maybe even early next. So if that's the case, you're probably a little bit worried about all that money that you have saved away in S&P 500 index funds. However, had you invested in inverse ETFs to start this year, you could be up 30% instead of being down like probably most of your friends who are invested in just traditional equities. One thing real quick before we actually get into what inverse ETFs are, how can you invest in them? Is it a good idea or a bad idea? I put a lot of time into these videos and a lot of research, so all right, let's get into it. So probably the best way to start this video is to explain just what exactly is an inverse ETF. Probably sounds a little bit like a weird name. What is this? Is this some strange investment opportunity? Yes and no. So an inverse ETF is an exchange traded product that tries to do the exact opposite of what a traditional ETF or index fund does. And an index fund seeks to track the performance of any given index. So like the S&P 500 or the NASDAQ or the Russell 2000. An index fund seeks to match exactly the performance of that index and not try to beat it or not try to underperform relative to that. And an inverse ETF seeks to do the exact opposite. So as a good example, just to quickly explain what an ETF is, if you're not familiar, the most popular S&P 500 ETF is called SPY. And again, this fund seeks to track the performance of the S&P 500. And probably the best way to understand what SPY does and what an index fund does is imagine it's like a giant pie with 500 different slices. So it's the 500 biggest companies in the country by market cap. And all of these pie slices, the 500 of them, are gonna have different sizes. And each of those sizes vary on a daily basis, depending on how valuable each of those companies are. So some of the biggest companies you've probably heard of, obviously like Apple and Amazon, have a much bigger slice of the pie than some of the smaller ones that are maybe ranked 500th or 499th. And on a daily basis, those values are changing. And so SPY is also trying to match that. And so the percentage of one share is going to hold a little bit of Apple, a little bit of Netflix, a little bit of Google, and then a very, 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 very small amount of whatever the 500th ranked company is at that time. And so this is actually where the inverse ETFs come in. So they look at that pie with the 500 slices that the SPY is tracking, and then it does the exact opposite. So essentially it's taking a short position or it's betting that all of those stocks are going to lose value. So to understand how this works, if you have $100 of SPY in your portfolio and then $100 of an inverse fund to that, you have $200 total dollars in your portfolio. No matter where the market moves, up or down or sideways, left, right, you're always gonna have that $200 in an ideal world. But at any given time, if you've started with equal amounts of money in both sides of the position, then essentially you're just never going to have any gains. You're going to be perfectly hedged against gains or losses. So of course, this isn't exactly a wise investment decision because you're going to put your money in and it's not going to go anywhere. It's not going to go up or down. It's just going to stay flat. So this is why really prudent investors will use inverse ETFs when they're expecting downfalls in the market. So what's the best strategy to use inverse ETFs? When should you use them and why? So basically how it works, if you invest in an inverse ETF, you're going to win when other people are losing. When the market is crashing, your portfolio is going to be going like this. And the key to doing well with inverse ETFs is timing the market. And I actually say this with a little bit of hesitation because timing the market is of course extremely difficult to do. If it was easy to do, then people would be making themselves millionaires overnight because they'd be making fantastic investment decisions. And obviously we know that even investment professionals have an extremely hard time doing this. So remember, if you're betting that the market is going to crash, it's exactly what it is. It's a bet. But I think in the macroeconomic environment that we're in today, where a lot of people are predicting a market crash and a recession over the next couple months or maybe year, it might actually be a good time to think about investing in an inverse ETF. Now, some other pros to inverse ETFs is that it's effectively a safe way to short stocks. Traditionally, when you short stocks, you have a lot of downside risk. So if your bet essentially isn't a great bet, you can lose substantially more money than you've actually invested in the first place. So it can be actually really dangerous and really risky for investors, especially ones that don't really know what they're doing. Now, an inverse ETF is protected against those downside risks because you can only lose the money that you've invested in the fund. If you invest $1,000 in an inverse ETF, if that inverse ETF goes to zero, your money, is now worth nothing. You get nothing, but there's never going to be a negative balance where you'd have to repay or, take out a loan to cover the losses. The only risk and exposure you have is the money that you've invested in the fund. And I think another great pro is in a recession, it's really hard to pick out who are going to be the losers and who are going to be the handful of winners. And an ETF is a great way to, instead of having to pick one or two or three winners, you're picking, who are on average, who's going to be losing? Who are the 500 losers here? And I think that's a much easier bet to make, especially when you're pretty confident where the economy is going to go. And probably the biggest one, warning, disclaimer, listen up to this one. Generally, the stock market goes up over time, right? So if you're investing in inverse ETFs, you're taking the opposite position of that. You're betting that the stock market is going to go down. And as we know, over a great amount of time, over the last 100 years, the stock market generally goes up by about 8 or 9% per year. Of course, there's ups and downs where some years it may be up 20%, other years it might be down 20%. And so that's what you're trying to find is those years where it's going to be down 20%. So inverse ETF investing is definitely not something you should do for a long period of time because again, over the long term, the stock market's going to go up and you don't want to be holding the opposite position to that because you're probably going to lose a lot of money. And I think another con here or another little warning is that, this is a little bit more of an advanced investing strategy. So if you don't really have a solid portfolio and a solid understanding of ETF investing and just investing in general, this is probably something I would stay away from. It's not needed, really for the vast majority of investors. I think the vast majority of investors would be much safer just investing in traditional ETFs and buy and hold and just sit there, ride out the ups and downs and enjoy your life in retirement once you become a millionaire. And another big con here is that inverse ETFs tend to have really high expense ratios. Traditional ETFs generally have extremely low costs because they're low maintenance. The investing is generally done by a program or computer, so there's not a lot of human interaction. And so the funds can be offered at an extremely low cost. Inverse ETFs are a lot different. There's a lot more involved because they're taking short positions. They're doing a lot of stuff behind the scenes to create this inverse position. And so fees tend to be around 1%, which is pretty high. So definitely something to be aware of. All right, now we know exactly what an inverse ETF is. We know what some investment strategies are for using them. We know what the pros and cons are. Now let me walk you through 3 inverse ETFs that I think you should explore if you're interested in investing in one. All right, so this is the first inverse ETF that I want to show you guys. The ticker is SH, and it's the ProShares Short S&P 500. So just doing the exact opposite of what the S&P 500 is doing. So you can see here it's issued by ProShares. The expense ratio, again, is fairly high at 0.9%. And we could see here assets under management, about $2.7 billion. And looking at performance here, probably what everybody is most interested in. Over the last year, they've returned about 21%. And again, pretty much matches what we know of the S&P 500, that it's down about 20%. All right, so the second inverse ETF that I want to share with you guys is ticker PSQ, or the ProShares Short QQQ. And this inverse ETF actually tracks the NASDAQ, or is the inverse to the NASDAQ. So the expense ratio here a little bit higher than the previous one, SH. This expense ratio is 0.95%, and about half the size of the previous fund at $1.3 billion. And performance-wise, over the last year, 31%. Again, pretty much exactly matching what we know of how the NASDAQ has performed, although the inverse, right? So the NASDAQ's down about 30%. All right, and now third but not least, ticker RWM, the ProShares Short Russell 2000. And just like this one sounds, similar to the other 2 I've shared, this is the inverse ETF of the Russell 2000. Expense ratio very similar, 0.95%. And again, continuing to get a little bit smaller. This one only has about $500 million of assets under management. And performance over the past year, about 25%.
Woo-wee. My goodness. I mean, if this isn't the play, what else is? You heard it here first. Who else is telling you these types of things? Here's a little bit more info before you go.
Welcome to the channel. Well, there's no missing it these days. Warnings of the coming recession and the stock market crashing every day for the past year is all over the news and your YouTube feeds. But I have some good news for you. You don't have to lose money in markets like this. It's true, you can make money in red stock markets. So in this video, I'm going to show you exactly step by step what inverse ETFs you can buy with a click of a button that actually make money as the stock market is crashing. And so one way to make money in a market like this, when everything else is crashing, when everyone else is losing money on stocks as they fall, is to go short or to buy an inverse ETF. And what going short means is that you're betting that stocks will fall in price. Normally this would mean that you have to borrow shares of a stock inside of your stock brokerage, but I'm going to show you actually an easy way to go short on the stock market, going short an entire index without taking risky loans or going out on margin. And you can do this just by buying something called a short ETF and buy and sell it, trade it like a normal stock. These inverse ETFs are almost the same as normal ETFs. The only difference is that these are short rather than long, meaning that when the index they track loses money or goes down in price, a short ETF goes up in price, meaning red days are green and green days are red. Now, why would you buy a short ETF? The main reason a lot of investors do this is because unlike when you borrow a stock to go short, with an inverse ETF, it's impossible for you to personally get margin called just by holding these ETF shares normally, and you don't have a risk of losing an infinite amount of money. The worst that can happen to an inverse ETF is that the price of the ETF per share can go to zero, whereas if you're shorting a normal stock, you could potentially lose an infinite amount of money. This is because if a stock is worth $100 and it goes to zero, well then you've only lost $100. But if you go short a stock betting that will go down and the stock prices increases to $1,000, you just lost $900. That's the difference between $1,000 and $100, meaning you lost more money than you went short and invested in the first place. And as you can guess, on the stock market, stocks can only fall to zero, but in theory, they can expand or blow up to infinity and go up in price. That's why many investors prefer short ETFs, so that way they still don't have that chance of losing an infinite amount of money. The first inverse ETF you should know about is SH. The ProShares Short S&P 500 is probably the most popular inverse ETF, and the reason a lot of investors buy this inverse ETF is that it gives you a -1 times daily return of the S&P 500 index. So for example, if the S&P 500 index were to drop by $1, this ETF would actually go up in price by $1. Because this ETF pretty much bets against the S&P 500, which is an index of the largest 500 companies on the stock market by market capitalization. In layman's terms, the S&P 500 is just the top 500 all-stars biggest US companies. So meaning that if you buy SH, you're betting that big companies like Apple, Microsoft, Amazon, Alphabet, and Tesla, and Johnson & Johnson, all the big companies on the S&P 500, are going to go down in price. SH has an expense ratio of 0.89%, meaning that for every $1,000 you invest in this inverse ETF, you would have to pay about $8.80 in fees. So for comparison, a normal ETF like SPY, which tracks the S&P 500 normally and is not inverse, that expense ratio is actually just 0.09%. So you can tell that the management fees in inverse ETFs are more expensive. Now these fees are automatically deducted and are reflected in the share price of the ETF, meaning that you won't actually see the money you're losing in fees go out of your account, but it's important that I make you aware of this, just so that you know what's going on in the background. So given that the market has been falling and crashing pretty hard recently, you're probably smart enough to guess that SH has been doing well, but the question is, how well has it been doing? As of this video's release in June, the S&P 500 is down 19.9%, while SH is up this year 21.2%. So for an easy comparison, if you had two stock trading accounts, each with $10,000, and one of your stock trading accounts you invested all into the S&P 500 ETF, SPY, because you wanted to invest long-term in the S&P 500, as of this video's release, you would have just $7,715 left of your original $10,000 investment, even if you reinvested all of your dividends. Now, if you bought SH with your other trading account because you wanted to go short on the S&P 500, thinking that those 500 companies would go down in price, your $10,000 investment would be worth $12,570, gaining you $2,570. This is just a snapshot of this moment in time as I'm recording this video, so do your own research, and these percentages could easily change as we are in a crazy market right now and a lot of things could happen. Now, in my opinion, SH isn't a bad inverse ETF, but it's not necessarily the best inverse ETF either. The S&P 500, the index you're betting against with SH, has the strongest and biggest companies in the US stock market, and as a result, they tend to fall slower than other smaller companies and are more likely to get bailouts and stimulus from the government when times are bad, compared to smaller stocks. Also, when liquidity dries up and banks don't have a lot of money to loan out, which is what some people are saying is happening right now in the stock market, the biggest companies are generally the last companies to lose their line of credit from lenders and banks. I've learned that you shouldn't be surprised when the biggest and toughest boxers on the stock market can take more hits compared to other stocks, and when those big stocks are knocked down, they tend to get up faster than the other stocks. It just makes sense that the biggest companies can take more abuse than smaller companies. The next inverse ETF that a lot of investors have been using is SQQ and PSQ. SQQ is the Ultra Pro Short QQQ, which is an inverse leverage ETF that tracks the NASDAQ 100 index. And the NASDAQ 100 is the largest companies, both domestic and international, listed on the NASDAQ stock market, prioritized by market capitalization, so from biggest to smallest, and it excludes financial institutions, so that means it excludes banks and insurance companies. This means that investors in SQQ are preparing for the greater non-financial stock market to struggle. And since the NASDAQ 100 tends to be heavily weighted towards technology, telecommunications, and healthcare and biotech, the SQQ and PSQ tend to perform well when these sectors perform poorly. So the expense ratio in SQQQ is 0.95%, meaning that if you were to invest $1,000 in this inverse ETF, you'd be paying $9.50 in fees. And from the start of this year, if you had invested $10,000 in SQQQ, that investment would be worth now $22,286. In that case, it would be more than doubling your money with a 123% gain since the beginning of 2022. The reason I'm mentioning this inverse ETF is because it's really popular online right now with investors, particularly on Wall Street Bets. I can see that they're talking about it a lot. But what makes this inverse ETF, SQQQ, different from the last inverse ETF I mentioned is that it's a 3 times inverse ETF. What that means is that this ETF uses leverage and borrowed money to increase your gains and losses by 3 times. So it's borrowing 3 times the amount that it's betting on. Meaning that if the NASDAQ 100 were to fall $1, you would make $3 with this inverse ETF. But on the flip side, if the NASDAQ were to go down $1, you'd be losing $3 instead of the normal $1 that would be lost. If this amount of leverage and risk is too much, but you still want to short the NASDAQ 100 and all of its tech-focused stocks, there is a nearly identical ETF called PSQ. And you can see that $10,000 invested in this inverse ETF from the start of the year would be worth $13,769 for a 38% gain. PSQ is different because it's only a 1 times inverse ETF rather than 3 times. My opinion on this one is that SQQQ is a gambler stock, and while it's true that tech stocks have been hit the hardest during this most recent market pullback compared to some of the more mature companies on the S&P 500, the QQQ index has fallen more than the S&P 500, but it's also true that the tech stocks of the Nasdaq 100 were growing and increasing their revenues pretty steadily before the market pullback, and it's possible that these tech stocks are growth stocks and they could recover more quickly compared to other stocks. I don't think anybody is in doubt that tech is a great sector, and it's likely the future of the economy, so while it's true that going short on an inverse ETF like PSQ or SQQ so far has made investors more money than other inverse ETFs, such as people inversing the S&P 500 with SH, caution is definitely warranted in my opinion. You are betting against some of the biggest winners on the stock market on the QQQ index. The next inverse ETF is RWM, which is the ProShares Short Russell 2000. RWM provides a one-day bet against the Russell 2000's index of 2,000 US small-cap firms. And just like all the ETFs before, this one is one of those ETFs that bets every day that the Russell 2000 stocks will go down in price. And so if these stocks go down $1, you make $1 minus the expense ratio. And if those stocks go up $1, you lose $1. And if you look at the top holdings for the normal Russell 2000 index, you'll see stocks like Chesapeake Energy, Range Resources, BJ's Wholesale Club, and Macy's. And as Zoomers would say, these stocks on this index are pretty mid. The expense ratio in RWM is 0.95%, which is about the same before with SQQQ. It's on the higher side, but most inverse ETFs, as I mentioned, tend to be more expensive than normal ETFs. So $10,000 invested at the beginning of this year in RWM would be worth now $12,984, where if you were still going long and just buy and hold the normal Russell 2000 with an investment of $10,000, that investment would only be worth $7,374. For full disclosure, I do currently have a position in RWM, and the reason I chose this particular one is because I learned that during economic times, smaller firms and smaller stocks tend to get hit the hardest and are overlooked when bailouts and help does come from government spending and consumer spending rebounds. So for comparison, shorting the S&P 500 with SH has had a 25.7% gain since the beginning of this year, and RWM during that same time period returned 29.84%, and PSQ, on the other hand, shorting the QQQ index, has returned 37.69%. So you can see that out of these three inverse ETFs, RWM is about in the middle of the pack. I like RWM more because to date it has returned more than the inverse S&P 500 bets with SH, but at the same time I feel that it's less risky to bet against the QQQ with PSQ. And you can see that it's at the middle of the pack. It's not as risky necessarily as PSQ in my opinion, but it returns more than betting against the S&P 500 with SH. Now, of course, it's impossible to deny though that this most recent market cycle, up until this very moment, investors who have been shorting the Nasdaq 100 with PSQ have been making more money compared to people holding RWM. You're fine to disagree with me and buy any other inverse ETF if you like. I'm merely informing you of the existence of some of the more interesting ETFs I've found. For me though, PSQ is just not within my risk tolerance, but it may be within your risk tolerance, so that's up to you to decide. The next part of this series of inverse ETFs I've been telling you about is just a series of ETFs to expand your knowledge. I personally don't know anybody investing or betting in these ETFs that I'm about to tell you, but I think it's important that you do know that these inverse ETFs exist. On the stock market, you may not know this, you can go short on precious metals like gold and silver. I was very surprised to learn this as well, and I found two ETFs you can buy to bet against gold and silver. The two of them are GLL, which is the ProShares Ultra Short Gold ETF. That's 2 times leveraged, meaning that if gold went down $1 in price, you would make $2. And the second is ZSL, the ProShares Ultra Short Silver ETF, and this one is also 2 times leverage. We'll start with GLL, the Ultra Short Gold ETF, and this probably won't come as a surprise, but GLL, a bet against gold, has returned negative 6.5% since the beginning of the year, and this is because gold's price has held relatively stable and steady as inflation has risen, and the price of many stocks have been following. However, if there is someone out there who thinks and believes that investing and holding in physical silver and gold is a bad investment, this would be one way. If you were to buy an ETF like GLL, this would be one way you can profit from other investors being wrong buying and holding gold ETFs and physical gold. And if you think later that the economy will get better and stocks will go up, it's entirely possible that gold's price could suffer. Gold's price has fallen in the past on the ETFs, and so there is an opportunity here for you to make money. Now, I don't personally believe this, I'm just giving the counter argument, but you should be aware that this option does exist for you out there as an investor, and maybe there is a maverick genius investor who we don't know their names yet. Maybe they will bet against gold at some point and make a lot of money. So GLL is an inverse ETF for people who don't like gold. And the last inverse ETF I'm going to tell you about is ZSL, the ProShares Ultra Short Silver ETF. And if we look at this ETF's performance, unlike gold, silver's price has been ever so slightly falling and not keeping up with inflation, meaning that people who have been buying and holding silver have been steadily losing money since last year. So as a result, the ZSL inverse ETF actually returned a very small profit of 1.01% or $101 on a $10,000 investment since the beginning of 2022. Again, I don't necessarily believe in betting against precious metals. Their prices do tend to be pretty stable, but I also understand that it is true that so far the price of gold and silver haven't been keeping up pace with inflation. In fact, to date, the only assets I've seen that have kept up with inflation are farmland, energy, and real estate. But just because gold and silver aren't growing fast or going up in price, it doesn't necessarily mean that it would make a good short. So there you have it. Those are the 5 most interesting inverse ETFs you can buy to make money from falling stocks and other commodities, as others are losing money on the stock market. It's really important that you're aware of alternative strategies other than just the orthodoxy, buy and hold, and you should be aware.
The play is in. Now it's just about execution. Do your due diligence. Do your homework before you make plays. Okay? Study the ETF of interest. Be careful. If you got any questions, let me know. We got another one in the books. Appreciate you all. We're going to have more valuable content coming your way.